Quick note before we start, I'm not a financial advisor, and nothing in this video is personalized advice. It's general education about how diversification works and why certain assets behave the way they do. Always think about your own situation and talk to a licensed advisor before making changes to your money. Let's start with a simple question. Why do people bother owning more than one type of investment? Why not just put everything into the stock market and let it ride?
The answer comes down to one word: correlation. That's a fancy way of asking, when one investment goes down, does the other one usually go down too, or does it do something different? If two investments always move together, owning both doesn't actually protect you from anything. You're just holding the same bet twice. Real diversification means owning things that tend to respond differently to the same event. Think about what happens during a recession. Companies sell less, profits shrink, stock prices usually fall, sometimes sharply. In 2008, the S&P 500 dropped by about half from its peak to its bottom. That's not a small dip. That's half of people's retirement accounts gone on paper in about a year and a half. Some of it came back over time. Some people sold at the bottom out of fear and locked in the loss for good. That's the real risk of concentration, not just that prices fall, but that big drops make people panic and make decisions they regret. So what do people add to try to smooth that out? Three categories come up again and again: government bonds, especially short-term treasuries, gold and silver, and a mix of other real assets like real estate. Let's go through each one honestly, including the downsides, because every asset has downsides. Start with treasuries. These are loans you make to the US government. You give them money, they pay you interest, and at the end of the term they give your money back. Short-term treasuries, meaning ones that mature in a few months to a couple of years, are considered about as safe as a dollar-denominated investment gets because the US government has never failed to pay its treasury debt. That safety is the whole point. When stocks are crashing and everyone is scared, money often flows into short-term treasuries because people want a place to park cash that isn't going to lose value overnight. The trade-off is that treasuries don't grow your money much. Over long periods, they've historically returned less than stocks. And if inflation runs hotter than your treasury's interest rate, you're actually losing purchasing power even while the account balance looks fine. That happened in the 1970s. Inflation ran into the double digits some years, while many bonds paid less than that. People holding those bonds kept their dollar amount but could buy less with it every year. So treasuries protect against market crashes, but they don't automatically protect against inflation. Those are two different risks, and it matters which one you're trying to guard against. Now, gold and silver. These get talked about constantly in finance content, so let's be precise about what they actually do and don't do. Gold doesn't pay you interest or dividends. It doesn't grow a business or create anything. Its value comes almost entirely from the fact that people have treated it as a store of value for thousands of years, and central banks around the world still hold large gold reserves today. Because it's not tied to any single government's currency, some investors use it as a hedge, meaning a bet in the opposite direction, against the dollar losing value, or against a crisis of confidence in paper currencies generally. Here's the historical pattern people usually point to. During the 1970s, when inflation was high and the dollar was weakening, gold went from around $35 an ounce to over $800 an ounce by 1980. That's a real example of gold doing what people hope it will do, but it's worth knowing the other side too. After that 1980 peak, gold spent the better part of the next 2 decades going nowhere or losing value in real terms. Someone who bought at the top in 1980 didn't get back to even, adjusted for inflation, for a very long time. Gold can sit flat for years. It doesn't move in a straight line, and it doesn't move in sync with any predictable schedule. Silver behaves similarly to gold but is more volatile in both directions, partly because it's also used in industrial applications like electronics and solar panels, so its price reacts to factory demand as well as fear demand. That makes it swing harder than gold, up and down. The honest summary on precious metals: they can act as a kind of insurance against currency and confidence crises, and they've historically had low correlation to stocks, meaning they don't necessarily fall when stocks fall. But they don't produce income. They can go through very long stretches of doing nothing, and timing matters enormously. Buying gold after it's already spiked is a very different bet than buying it before a spike, and nobody can reliably tell you in advance which moment you're in. Then there's real estate and other real assets, things like farmland, infrastructure, or real estate investment trusts, which are funds that let you own a slice of many properties without buying a building yourself. The appeal is that real assets often keep pace with inflation over time, because rents and property values tend to rise when the general price level rises. They can also produce income, unlike gold. The downside is they're less liquid, harder to sell quickly, and they carry their own risks, local market downturns, interest rate sensitivity for REITs, vacancy risk for landlords, and so on. Though if none of these assets is perfect on its own, what's the actual point of combining them? It's not that any single one guarantees safety. It's that they tend to struggle at different times for different reasons. Stocks are hurt by recessions and falling corporate profits. Long-term bonds are hurt by rising interest rates. Gold can sit flat for years when there's no inflation or crisis narrative driving it. Real estate is hurt by high interest rates and weak local economies. When you hold a mix, the years that are bad for one piece are often not bad for all the pieces at the same time. That's the entire theory. It doesn't eliminate losses. It's designed to reduce how violently your total net worth swings so you're less likely to panic sell at the worst possible moment. A useful way to think about your own mix is to ask how many years away you are from needing the money. If you're decades from retirement, you likely have time to ride out stock market drops, and history suggests stocks have rewarded that patience more than any other major asset class over long periods, though past returns never guarantee future ones. If you're a few years from needing the money, or you're already retired and drawing on it, a market crash right before or during that period can do real damage you don't have time to recover from. That's usually when people start shifting more into shorter-term treasuries and diversifying assets, not because those assets earn more, but because they're trying to protect money they can't afford to lose right now. None of this means you need 4 buckets and fixed percentages, or that there's one correct formula that works for every person. Your mix depends on your timeline, how much volatility you can actually tolerate without making panic decisions, and what you're trying to protect against a stock market crash, inflation eating your savings, or both. Those call for somewhat different tools, which is exactly why relying on one asset class rarely covers all your risks. If you want to actually learn more instead of just watching another video, here's something concrete you can do this week. Pull up your own portfolio and sort everything into 3 simple buckets: things that do well when the economy is growing, things that do well when the economy is shrinking or scared, and things that mainly track inflation. Most people find they're almost entirely in the first bucket without realizing it. That's not necessarily wrong, but it's useful to actually see it in front of you rather than assume you're already diversified. One last honest point. A lot of finance content, especially on YouTube, borrows the name of a famous investor, invents an urgent countdown, and tells you exactly what to buy right now. Be skeptical of that pattern specifically. Real diversification isn't a secret 4-asset formula revealed in the next 10 minutes. It's a personal trade-off between growth, safety, and inflation protection based on your own timeline, and it's worth building with a professional who actually knows your full financial picture, not from a script designed to make you scared enough to act today. That's it for this one. If you want, the next video in this series can go deeper into just gold and silver, how they're priced, how to actually buy them safely, and the real costs and risks of doing so. Or we can do one on bonds and treasuries specifically, including how interest rate changes affect bond prices, which trips a lot of people up. Let me know which one's more useful.